Disney earnings are out this morning. Earnings beat estimate. Revenue just slightly below. Joining us now is Hugh Johnston. Disney CFO Julia Boorstin is here as well. The stock, Hugh, it's good to see you. And I don't know where you want to start. Maybe start with earnings because I think on the other news, the stock was reacting positively. It's up at, I think, 122. Now I think 117, 116 after, I guess, maybe Julia pointed out, you've been beating revenue estimates in recent quarters, so a slight miss here. You want to start with that?
Yeah, happy to go through the earnings. So overall, very good quarter for us. 2% revenue, 8% operating profit, 16% EPS. Most importantly, in a lot of ways, the two strategic businesses for us, the direct-to-consumer business, had a great quarter, made $350 million, well ahead of estimates, grew subscribers by 2.6 million, and revenue was up 9%. And then experiences, where there's been a lot of concerns, of course, because of the new Universal Park down in Florida. We really blew away the quarter, 8% revenue, 13% operating income. And Walt Disney World had its biggest Q3 ever. So certainly feel good from the perspective of those businesses. Traffic was solid, up a little bit, and then per caps were up very, very solidly. So, I know there's lots of concern about the consumer in the United States right now. We don't see it. Our consumer is doing very, very well.
The stock's been on a roll, obviously. But the promise of DTC and streaming and Disney Plus got that stock up. People were ahead of themselves. So excited back in, I guess during COVID. It was almost $200 a share.
It had a moment. It didn't last long, but it had a moment.
That was when everything was going to be streaming forever, and Hulu was worth $12 trillion and all that, and we came back to earth a little bit. But now you've got $350 million to talk about.
Well, that's it. The business, we raised the guidance on that business from $1 billion of profit this year to $1.3 billion. And just as a reminder, it was only a couple of years ago, we were losing $1 billion a quarter on that business.
Right.
It was trading purely on subs and not on financial results. We now really have a solid foundation. What I like is strategically we're in a different spot than our competitors in that if you think about Disney, ABC News, Marvel, Pixar, we make most of the content that we put on the streaming service, whereas our competitors rent their content. Even ESPN really adds a lot of value and makes a lot of its own content. And I think that's the differentiator for us, and it's going to allow us to continue to grow. It's also part of the reason we're adding 10 million subs in Q4.
So all of this news you just announced for ESPN and this big deal with the NFL, how does that change your outlook for this ESPN app that you're now launching on August 21st? And what does that all mean for this bundle that you're going to be pushing to consumers?
Yeah, so we're excited about the bundle, certainly, because what it does is it gives people yet another reason to not trade out and to churn out of the business. So as you know, churn is the thing that you really are trying to manage, and ESPN is another good reason not to churn. In terms of ESPN itself, to me, we're really innovating for the sports consumer, because if you have a connected phone or a connected TV, or you have a mobile app, you're going to be able to do so much more than just watch sports. You'll be able to do multi-view of games. You'll actually be able to get a personalized sports center. So, Joe, for you, you'll be able to see the Bengals and be able to see the Reds, basically a sports center that is just created for you. And in addition to that, betting, fantasy sports, e-commerce, all of that we think is going to make it really, really sticky. And we're making the price attractive. At $29.99, you get not only ESPN, Disney Plus, and Hulu.
Is that enough, $29.99, is that enough to make up for what you would have gotten from the cable bundle? Because people always talk about trading, analog dollars for digital dimes.
Yeah, it's closer at this point, Becky, to tell you the truth. And in addition to that, we think we're going to pick up a lot of people who are either cord cutters or cable nevers, so they're gone anyway. Right. And for us, the purpose of ESPN is to reach sports fans however they want to get there. That's the objective. So we think it's going to be accretive to overall earnings for us.
Do you have a sense, though, when it comes to the overall cable business? I remember when Bob Iger told me years ago that he realized that there was this trend that they needed to address by shifting into streaming. in terms of this trend, in terms of cord cutting. Do you have a sense of how the overall ecosystem will be impacted, especially now that you have all this additional NFL content? Will you see cord cutting maybe more broadly for your other channels as well?
It's a great question, and candidly, no one really knows the answer to it. I think the notion of sports being the one thing that's holding cable together is a highly overrated concept. I really do, because there's a lot of reasons why people retain cable, and as we've seen, the cord cutting is leveled off a little bit anyway. So I'm not that worried about that. To me, what we're trying to do as Disney is we try to be pretty indifferent as to where the consumer wants to go. If they want to stay in cable, we're there for them. If they want to stream, we're there for them as well. And if you think about what Bob did a few years ago when he came back, he laid out 4 planks of creativity and sports and streaming profitability and then turbocharging the parks. Then a year ago, he said we were going to move from fixing to building. And now we're really in a mode where we're doing things for the consumer. We're building for the consumer. So I think that's what makes Disney a little bit of an entertainment company like no other, because we can kind of be where the consumer wants to be.